Hi there, welcome to Kneppy Invest. On December 26, 2024, I released a video titled Finding High Quality Stocks Using a Fin Chat Screener. And I completely forgot I did this video until the other day when I thought maybe I should do a video on some of the metrics that I do look at when deciding whether a company might be high quality or not. And I just went back through all my past videos, and then I discovered this. And yeah, of course, my memory's not that good. Discovered this, and I thought, oh, let's use this screener with a few tweaks and adjustments and apply it to other exchanges in the world. And that's exactly what I'm going to do over quite a few videos, starting in this video looking at the New York Stock Exchange. So let's get into it. And the good thing is, when you do use a screener in FinChat, it is saved unless you make an adjustment. And if you do make adjustments, you can actually save it and then do another screener. So I am thinking of doing an income screener. So that would be using completely different metrics than a quality screener. Okay, so what am I looking for when it comes to high quality companies? Now, this is completely objective, no subjectivity when it comes to this particular screener. Well, when I say that, I'm talking about when you do look at the quality of a company, sometimes you will have to look at the management, the company itself, what they're doing. And some of that can be quite subjective, but when you're looking at numbers, you're completely disregarding management, what the company does. You're just looking at the numbers. But there is some subjectivity when it comes to what numbers are you going to use? What metrics are you going to use? And that's probably the most important thing when it comes to this. So it's taken me a long time to realize what I need to look at, personally need to look at when it comes to high quality companies. Now, the first thing I always look at is revenue growth. So I'm looking at the last 5-year revenue growth, and I want that to be at least 5% per year. I do prefer it to be above 10%, but I will look on an individual basis companies that are growing their revenue between 5 and 10%. Now, the first one in this is total return since inception. I don't have any filter there. I just want to see how the company has performed since it listed on the exchange. The next thing I'm looking at is diluted earnings per share. Now, in the past, I've left this unbounded, I suppose you could say, without any sort of percentage I'm looking for. But I've put here 5%. So I'm looking at only those companies that have provided a 5% return or 5% increase per year in earnings per share. Return on invested capital, 5-year average, I've put that at 5%. Now, I was thinking of just leaving that 10%, but I've just put that down just to catch a few more companies. Return on invested capital in this particular year, I've left that unbounded. And I just want to compare return on invested capital over the last 5 years as an average versus return on invested capital in the past year. And what I'm looking there is for any sign of growth or change in return on invested capital. Free cash flow yield is more of a valuation metric. Same with PE, same with PEG ratio, or the way you look at PEG ratio is based off the expected growth in the company. Is the company cheap right now? So the most important thing there is expected growth, and expected growth can be quite wrong. Another thing I'm looking for here is dividend per share growth. Now, this is not really a metric I would look at when deciding whether a company is high quality or not, but I do like to see companies who are growing their dividends over time. And another one I'm looking at is gross profit margin. I've put that at 30% or greater. And I'm also looking at the gross profit margin over the past 5 years. In fact, what I might do here is actually put the gross profit margin in the past year at 0% and put the 5-year average at 30%. Sort of the same thing with what I've done with return on invested capital. So there we go. So I'm running the screen filter right now. And previously we came up with 191 hits. Now we're down to 100 184 hits. Now, something else I should mention is I've excluded mining companies, metals and minings, oil, gas, and consumable fuels. So you can leave out any sort of industry that you think is difficult for a company to be high quality. I definitely think, just my opinion, that mining companies have a really hard time have a really hard time showing the characteristics of a high quality company just because they are typically price takers. Okay, so we can hide the filters, and I'm not going to do this for every single video. So I'm going to hide this. And these are the companies that pop up, all listed in rank by market cap. So what was it? 184 hits. Companies ranging in size from $725 billion all the way down to the smallest company that satisfied these particular filters, a company called X Financial with a market cap of $113.8 million. Okay, so let's start off the top. And what I'm going to do is I am going to be looking for companies that I don't know anything about. But in this video, what I'll do is I'll just look at some of the bigger companies within this list, because I do know these companies. In fact, 2 of the top 4 companies I have invested in. And those 2 companies are Eli Lilly and also Oracle. And the other 2 companies, Visa and Mastercard, are definitely companies that I've thought about buying in. And these would be near the top of my list of high quality companies that are yet to own. But more than likely, I'll have to choose between Visa or Mastercard. I don't want to own both because they're almost identical in my opinion. So what I'm going to do now is just have a look at these 4 companies, Eli Lilly, Visa, Mastercard, and Oracle, and just go through some of their metrics. And then we'll have a look at the chart. And what I'm going to do is have a look at the weekly chart and the 200-week moving average, which can be a good indication of whether a company is high quality or not. Whoops, I got to use the right keyboard, don't I? Eli Lilly. Whoops, got to spell it right. Eli Lilly. What's the ticker code again? Can't believe I'm a shareholder, don't even know the ticker code. LLY. Okay, so we'll just have a look at the 200-week moving average, no other average. And you can actually determine a lot just by looking at a chart of a company over a long period of time. Okay, so let's have a look at Eli Lilly, and then we'll go through the other 3 companies. I might also have a look at Home Depot, because I definitely know that company. I wouldn't say know it well, but a fairly similar company to Bunnings. And there's also another company similar to Home Depot in America. I forget what it's called. But after that, the company coming in number 6 is a company called Abbott Laboratories. I have no idea what the company does. No idea. So this is a new company. And what I'll do in the next video is I'll start at Abbott Laboratories and have a look at whether this is a potential buy for me, because it has come up in this particular filter. By the way, after Abbott Laboratories is American Express. There you go. So there's a bit of a theme among the top 7 companies in the New York Stock Exchange. Okay, Eli Lilly and Company. I do own this particular stock. Now, I also own Novo Nordisk. I actually do prefer Novo Nordisk in terms of valuation. But let's see why Eli Lilly and Company has satisfied these particular filters. Something else I might be doing is having a look at unfiltered New York Stock Exchange and just see which companies did not quite make it into this particular screener and see why. And I don't think this screener is absolutely perfect. I don't think there's any way you could set up a screener that's going to be absolutely perfect that would include every single high quality company and exclude all the low quality companies. I don't think that's possible. So there will be possibly some high quality companies that do not satisfy all these filters. And there might be quite a few companies in this list that are definitely not high quality companies. So let's start off with Eli Lilly, a drug company. It's been in the news over the last few years because they do manufacture those weight loss drugs, not Ozempic. Pretty sure that's Novo Nordisk. But anyway, pharmaceuticals market cap is $725 billion. Total return since inception, 14.6%. Since inception, one of the things actually I'd like to do is actually put in here somewhere when inception was. When inception was. I'm wondering... and I should have thought of this before. So I was doing that wrong. I wonder if it's going to be called IPO, no, or Inception, which is not the movie. Return since Inception, no. I'll see what screener I'd need to include to put in there when the company listed on the exchange, because I don't want to necessarily rule out companies that have not been listed for more than 5 years, but that is a part of my screener. I do prefer companies that have been listed for a while because we have more information. So let's hide the screens again. So Eli Lilly returned since inception, 14.6%, which is a nice return. I would take that. Revenue, 5-year CAGR, 16.2%. Earnings per share, 15.3%. Return invested capital, 22.6% average over the last 5 years. In the last year, 27.8%. So return invested capital has grown compared to the average. That's pretty nice. Free cash flow yield, 0.5%. So that is telling me there is a possibility that this company is a little bit overvalued. P ratio is 62.6, but PEG ratio is 0.7, which is the market saying that they do expect some significant growth in Eli Lilly in the future. A dividend per share growth at 15.1%, gross profit margin 81.7%. I'm wondering which one is that? That is, the first one is the current. What I might do is just move it, the 5-year average in front of the current. There we go. And then we can hide this again. Okay, so gross margins are pretty nice. So, I mean, these are all the characteristics of a high-quality company. There is nothing wrong here when it comes to Eli Lilly. Everything is looking pretty good, apart from possibly the valuation. Free cash flow yield and P ratio do seem low for free cash flow yield and high for PE, but doesn't necessarily mean it is, because there could be fairly significant growth in the future for this company. And that's why the PEG ratio is at 0.7, which probably suggests, based off the future growth or the expected future growth, this company is actually looking at pretty good value. So last thing I'm going to do is just have a look at the chart for this company. And this is the weekly chart. And the share price has gone bananas since about 2018. Back then, the share price was about $100. Now it's $812. Now, over the past, I'd say the past year and a half, the share price has gone sideways. And one of the reasons behind that is because the share price had run up a fair bit. So taking a breather right now, share price well above the 200-week moving average, but the moving average has almost caught up. And the last time we did see some good buying when it comes to the 200-week moving average was actually back in 2017-18. We can see actually the share price of Eli Lilly bouncing off the 200-week moving average twice during that period. But if we go back further, there was a long period of time, I think it was maybe 10 years or so, when the share price was actually below the 200-week moving average. So if I was recording this video in 2010, I probably would say this is not a high-quality company just because of what's happened in the previous 10 years. So even these companies that you might consider high quality, they can go through periods of time when they don't have the characteristics of a high-quality company. Just ask Microsoft and Microsoft shareholders during the period 2000-2015, because the share price of Microsoft did absolutely nothing, even though the company grew. Okay, so Eli Lilly has all the characteristics of a high-quality company, just the valuation at this point in time. So what about Visa and Mastercard? I'm going to use these, I wouldn't say compare these two companies, but I'm going to look at these two companies side by side because they are fairly similar, a little bit different in all facets. Now, before I did this little project, I probably would have said Visa is the higher quality, maybe slightly, or the better company, maybe slightly over Mastercard. I don't know why I would think that. It is the bigger company. Visa has a market cap of about $700 billion, Mastercard $536 billion. Now, I should also mention, I am recording this video on June the 13th at 2:30 p.m. So some of these numbers might be a little bit different because I probably will release this video about 3 months after I recorded it. So just keep that in the back of your mind as well. So Visa and Mastercard, Visa is a little bit, has a higher value than Mastercard, 700 billion compared to 536 billion. And hopefully everyone knows what these companies do. And hopefully that is true, because that would be concerned if you don't know what these companies do. Total return since inception, Mastercard 29.6%, Visa 21.7%. Revenue growth over the last 5 years, Mastercard 11.3%, Visa at 9.5%. So I do prefer 10%, but I will take 9.5% revenue growth. For these big companies, that's the sort of growth I probably would expect. Diluted earnings per share, roughly around about 12 to 13% for both companies. That's quite nice. Return on invested capital for Visa around about 20 to 25%. Mastercard around about 39 to 40%. So a little bit higher for Mastercard than Visa. Free cash flow yield slightly higher for Visa, 3% compared to 2.8%. That's actually quite nice as well. I don't mind that free cash flow yield for either company. P ratio, 37.2 for Visa, 41.4 for Mastercard. So that might be a little bit high for the growth in this company and possibly the forecast future growth, because the PEG ratio for both companies is above 2. Now, one of the reasons why I do think this company might be perceived as being a little bit overvalued is because they would be considered quite safe with pretty big moats. Now, there could be a little bit of disruption in this space. Buy now, pay later has been thought of as a possible disruptor in this space, but I think that's a small chance that the buy now, pay later would completely disrupt this particular space. So definitely moats here. And the other thing that these two companies have that make them really considered to be high quality companies is just the margins. Really high gross margins, almost 100%. So you don't have to worry about gross margins. And that's a really good indication these companies have a really good moat. It's going to be really hard for any competitors to come into this space. So Visa, Mastercard, both high quality companies. I have no doubt about that. Even if someone wanted to debate me, I don't think they could sway me going the other direction. It's just the evaluation, maybe a little bit higher, maybe a little bit overvalued than what I would like. Now, in saying all that, if we have a look at the charts for both these companies, Visa, you notice Visa. So if you go all the way back, so this company listed back in 2008. Funnily enough, they listed in March 2008. That's pretty bad timing. At the top of, or when the GFC started. But since it listed, the share price generally has been above the 200-week moving average, apart from 2 times. The first time, it touched the 200-week moving average during the peak in the COVID-19 financial panic. And during the tech sell-off in 2022, the share price of Visa fell below the 200-week moving average for about a month. What a great buying opportunity, and I completely missed it. Completely missed it. It was on my radar, and I completely missed it. And right now the share price, you just see it just grinding higher. And at this point in time, share price is at an all-time high, well above the 200-week moving average. And I wouldn't say I'm regretting not buying Visa at $180. Share price has doubled, but that's the way it goes. Mastercard, fairly similar chart. Almost, I wouldn't say identical chart, but just look at this. If it's coming, yeah, fairly similar chart. And in fact, it has the same characteristics as Visa. Mastercard listed a little bit earlier, in June 2006, and it touched the 200-week moving average in COVID-19 and fell below the 200-week moving average in October 2022. So fairly similar chart to Visa. Which one would I pick? That's probably the big question. Which one would I pick, Visa or Mastercard? And I think you can't go wrong choosing either one. You can even buy both of them. Okay, and finally we have Oracle. So I am an Oracle shareholder, a happy Oracle shareholder, because as I'm recording this, actually not as I'm recording this, last night or the previous night, they did report and the share price popped up 13% because they are seeing a little bit of really good momentum when it comes to AI. And so Oracle, this one is interesting because I would have called this Oracle a borderline high quality company Maybe on the quality spectrum, it's in the middle, sort of, it has some of the characteristics of high quality company, but I wasn't absolutely confident in describing Oracle as high quality. Now, that might change just because the company is expecting some pretty good growth because of the bullishness or the momentum when it comes to AI. So, market cap of the company is $500 million. Now, it's going to be interesting because when I release this video, Oracle should be releasing their next quarter results, the first quarter of the financial year. So I should be releasing this video just before they do release those results. So it's going to be interesting to see how Oracle share price has performed since share price rose 13% on May the, oh no, not May, it's June, on June the 12th, 2025. Okay, so let's have a look at some of the metrics of Oracle. Return since inception, 18.5%, which is probably exactly what you want. So this has been a really good hold since they listed. I don't know when they listed. We'll have a look at that in a second when we look at the chart. Revenue CAGR over the last 5 years, 7%. That more than likely will start to accelerate. In fact, we're starting to see signs. So what I'm going to do now is just open up Oracle, have a look at that overview. So if you have a look at the revenue growth over the last 3 years, it's 10.6%, 5 years, 8%, 10 years, 4%. So we're starting to see revenue accelerate because of AI. And that is also true with earnings per share. Over the last 3 years, increasing 21.7%, and the last 5 and 10 years only at 7%. So we are starting to see a bit of acceleration in this company's financial performance. What else do we see here? Earnings per share over the last 5 years at 6%. Again, that's accelerating. Return to invested capital, 12.9% over the last 5 years, 10.5% in the last year. So probably that could have been a red flag. That return on invested capital in the last year was lower than the last 5 year average, but still it's just above 10%. So that's a slight, it's a tick, but something you have to pay close attention to moving forward. Free cash flow yield at 1.2%, P ratio at 40.9. Now, as a holder, that was a little bit concerning based off the, I wouldn't say lack of growth, but I would want better growth than what this company has been experiencing in the last few years. But because they did have a really bullish quarter and their expectations for the next year were quite good, were much better than the market was expecting, I think P ratio of 40.9 might be a little bit justified here. And the PEG ratio at 3.8, and I think the market was expecting as much growth as what this company is going to experience. That's why the share price has popped up 13%. Dividend per share, growth at 12.1%, and gross margins, exactly what you want to expect, or what you want to see at between 70 and 80%. They could lift that. Software company could lift that. That would be nice. Okay, so let's have a look chart for Oracle. ORCL. Oops, I got to use the right keyboard. ORCL. So this company listed, I can't remember. It's been around for a while. Listed in 1986. There you go. And look at the tech bubble. Ooh, look at Oracle during the tech bubble. And then all the way back down. It's a Matterhorn pattern. But if you just ignore that period and just go have a look at the charts since about 2006, the share price has been consistently above the 200-week moving average. This is a characteristic of a high-quality company. A few times it's gone below it, and that has been the times to buy this company. Back during the GFC, it fell slightly below in 2016, and we can see the share price bouncing off the 200-week moving average quite often. During this 20-year period. During the COVID-19, it fell below quite significantly. And also, it fell below during that October period in 2022, when quite a few tech companies were pretty good value. And funny enough, just recently, during the tariff sell-off, Oracle actually got very close to 200-week moving average, and then look at that bounce. And it also, should mention, Oracle share price has reached an all-time high at $200. Or very close to $200. Yeah, share price up 13.3%. So yeah, so a nice little rebound with Oracle share price. And just based off their quarterly report, things are moving in the right direction. In fact, moving in a better direction than what the market expected, hence why the share price has popped up. Let's have a look at the daily chart, and daily chart looks pretty nice as well. So Oracle, I was debating whether this company could be considered a high quality company, even though I did own it. I think it's very, very healthy to look at some of your holdings and sort of ask the question, does my thesis for holding or buying this company still hold up? So I've been doing this with Oracle for a while, and I think what happened in the last quarter justifies, or maybe supports is a better word, that Oracle might be a high quality company. The other thing that really supports that thesis is just the long-term chart. This is a characteristic of a high quality company. The only concern I probably would have is the share price is well above the 200-week moving average, so there could be a little bit of weakness moving forward. But again, the momentum in the last quarter makes me satisfied that this could be a long-term hold, and maybe should be a long-term hold. Okay, so that's all I'm going to do for this particular video, looking at these four companies: Eli Lilly, Visa, Mastercard, and then Oracle. I suppose I'm going to have a look at Home Depot. Let's have a look at Home Depot. So Home Depot. No, we'll do that in the next video. Okay, so if you have any questions, any thoughts, leave those in the comment section of this video. In the next New York Stock Exchange high quality video, I'll look at some of these other companies, including Home Depot, Abbott Laboratories, maybe ServiceNow, Merck and Co, Accenture. And what I'll be doing is I'll also have a look in future videos at some companies I've never heard of before that have characteristics of a high quality company. So I'm looking for smaller companies that are really growing really nicely and have the potential to become behemoths in the future. Okay, so that's all I have for this video. If you have any questions, again, leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.